Most people think banks keep your money safe. They don't. The number on your screen right now, that balance you trust with your rent, your groceries, your life, is not a pile of cash sitting anywhere. It is, legally and technically, just an IOU. Banks have spent over a century building an image of impenetrable security, marble floors, iron vault doors, serious men in suits. That theater of safety is deliberate. Because the moment ordinary people discover the truth, history shows they react in one terrifying way. Here is the secret that transforms everything. Banks do not store your money. They spend it, lend it, invest it, and simply promise to give you an equivalent amount back when you ask. That promise is the entire foundation of modern banking. This is not a conspiracy. It is simply how the system was designed and has operated for centuries. But what happens when enough people figure it out all at once? The answer is one of the most destructive forces in economic history. December 10th, 1930. The Bronx, New York. A local merchant, furious over a stock dispute, started a single false rumor. The Bank of United States was running out of money. By nightfall, everything had changed. Over 20,000 people swarmed that single Bronx branch, desperate to withdraw their life savings before it was too late. Police were overwhelmed. The terror on those faces was not irrational. It was the perfectly logical result of suddenly understanding how banks actually work. This phenomenon, a bank run, is the financial world's most perfectly self-fulfilling prophecy. The bank does not need to actually be failing. The mere belief that it is failing causes the failure. Fear itself becomes the weapon that destroys the thing people were afraid of losing. Between 1930 and 1933, over 9,000 American banks failed, wiping out the life savings of millions of ordinary families. The government's response was the FDIC, Federal Deposit Insurance, designed to make bank runs irrational. For decades, it worked. Then the digital age arrived. March 9th, 2023. Silicon Valley Bank. Customers, many of them tech companies, received alarming news about the bank's bond losses and opened their banking apps. In a single day, they attempted to withdraw $42 billion. Not in weeks, not in days, in hours. Between 88 and 94% of SVB's $173 billion in deposits were completely uninsured, far above the $250,000 FDIC limit. The digital age had turned a century-old fear into a lightning-fast catastrophe. A bank run that once took days now took a morning. SVB's collapse proved one brutal truth. The vault myth does not just mislead us. It actively endangers us. To understand why the system is built this way, we have to go back to the exact moment money stopped being a physical thing. To understand where your money actually lives, we need to travel to the early 1950s, when banking was drowning in paper. The most skilled bookkeeper in America could update 245 accounts per hour. The entire financial system was threatening to collapse under its own paperwork. In September 1959, Bank of America deployed a solution, a 25-ton machine called ERMA. It contained 8,000 vacuum tubes and could process banking records faster than any human. More importantly, it introduced something still printed on every check you write today. ERMA introduced magnetic ink character recognition, the distinctive numbers still printed at the bottom of every check in America. But its deeper legacy was philosophical. For the first time in history, money existed primarily as data rather than as a physical object. Today, economists estimate that only 8 to 10% of the world's money actually exists as physical cash and coins. Everything else, 90% of all global wealth, is nothing more than digital entries on computer servers, numbers in a database, promises recorded in code. Now here is where it gets truly strange. Picture this. You walk into a bank and borrow $10,000 for a car. You probably imagine the bank opening a drawer, pulling out money another customer deposited, and handing it across the desk. That image is completely wrong. The bank does not hand you someone else's money. It simply types $10,000 into your account. Brand new money, created from nothing, in an instant, with a few keystrokes. This is how banks make money, and it has been hiding in plain sight your entire life. On March 11th, 2014, the Bank of England published a paper that dropped like a bombshell in academic circles. It stated plainly, whenever a bank makes a loan, it creates a deposit in the borrower's account, thereby creating new money. Not moving old money, creating new money. Commercial banks, not governments, not central banks, create approximately 97% of all money in the modern economy, simply by issuing loans. The government prints the coins and bills. Banks print the rest, digitally, invisibly, continuously, every single day. Historically, banks were required to hold a fraction of your deposits in reserve, a safety buffer of around 10%. Then came March 26, 2020. The U.S. Federal Reserve reduced the reserve requirement ratio to exactly 0%. Not 5, not 1, 0. American banks are no longer legally required to hold a single penny of your deposits in reserve. Strip away the marble and the vaults and the serious suits, and what remains is this. Modern money is trust, recorded in code. So how do banks actually profit from it? Imagine buying an apple for a penny and selling it for $20. In the banking world, this business model has a name, the interest rate spread. It is the invisible engine that runs 24 hours a day, 7 days a week, quietly extracting wealth from every account. The spread is simply the gap between what a bank pays you to hold your deposits and what it charges someone else to borrow that same money. Historically, the average spread hovers around 3.3%. But in specific products, the gap becomes a canyon. To fight raging inflation, the Federal Reserve raised interest rates dramatically in 2023. The average credit card interest rate hit a record 22.8%, the highest in American history. Borrowing had never been more expensive for ordinary people. Meanwhile, megabanks like JP Morgan Chase and Bank of America kept their standard savings account rates anchored at a microscopic 0.01% APY. While borrowers paid record rates, savers earned almost nothing. The spread had never been wider in the history of American banking. Here is the math made painfully real. You deposit $1,000 into a basic savings account. The bank pays you 10 cents in interest for the entire year. 10 cents. That same $1,000, lent to a credit card holder, earns the bank over $220. Multiply this across millions of accounts, and the numbers become staggering. In 2023 alone, JP Morgan Chase generated nearly $90 billion purely from net interest income, the spread between what it paid savers and what it charged borrowers. That fueled a record $49.6 billion in total annual net income, the most profitable year for any lender in the entire history of U.S. banking. All built on the spread. All built on the gap between the penny they pay you and the dollar they charge someone else. But the spread is not just an abstraction. It touches real lives. Consider Dallas Nestvold, a mechanic in Stacy, Minnesota who spent 20 years dreaming of owning his own auto repair shop. The banking system would both fund his dream and take its cut. Dallas turned to Stearns Bank, a local community lender. The bank matched his dream with deposits from a local nurse, a retiree opening a certificate of deposit, everyday people pooling their savings without ever knowing it. In October 2019, Dallas opened Revived Iron Auto Repair. The nurse's deposit earned interest while she slept. Dallas got the capital to build something real. The bank profited from orchestrating the exchange. Everyone theoretically won. But the bank's cut was not a small one. And that asymmetry is where things get dangerous. The banking system works beautifully until it doesn't. And when it breaks fast. The hidden risk is not just bank runs. It is the structural vulnerability built into a system where banks profit most when they take the most risk with your money. SVB is the clearest modern example. The bank had taken customer deposits and invested heavily in long-term government bonds, considered among the safest assets on earth. Then the Federal Reserve raised interest rates at the fastest pace in 40 years. When interest rates rise, the value of existing bonds falls. SVB's bond portfolio, worth over $91 billion at purchase, had lost approximately $15 billion in paper value. The bank was technically insolvent before a single customer withdrew $1. When news leaked on March 8, 2023, the bank's tech-savvy depositors did not line up outside. They opened apps. They sent Slack messages. Venture capital firms advised their portfolio companies to withdraw immediately. The information spread at the speed of social media. $42 billion attempted to leave in a single day. The bank's stock collapsed 60%. By the morning of March 10th, California regulators shut SVB down, the second largest bank failure in American history, executed in less than 48 hours. The SVB collapse triggered immediate panic at other regional banks. Signature Bank failed 2 days later. First Republic Bank collapsed in May 2023. The contagion was real and fast, a reminder that in the digital age, financial fear travels faster than any regulator can respond. The Federal Reserve and Treasury stepped in, guaranteeing all deposits at SVB regardless of the FDIC limit, a decision that cost tens of billions and ignited fierce debate. Had the government just told every large depositor that the $250,000 limit was meaningless? The deeper truth SVB exposed is this. The banking system is built on a knife's edge of confidence. Remove the confidence, and the math falls apart almost instantly. The vault was never the protection. The belief in the vault was the protection. And belief is fragile. So what do you actually do with all of this? Here are 3 things the banking system never wanted you to know, and what to do about each one. First, your bank balance is an IOU, not a pile of cash, which means where you keep your money matters enormously. FDIC insurance covers $250,000 per depositor per institution. If you hold more than that at a single bank, or if most of your deposits are in business accounts above that limit, you are exposed. Spreading deposits across multiple insured institutions is not paranoia. It is basic financial hygiene. Second, the spread is always running. While megabanks pay 0.01%, high-yield savings accounts at online banks and credit unions regularly offer 20 to 50 times more. In 2023 and 2024, some offered over 5% APY. The spread can work for you if you choose the right institution. Third, debt is the mechanism banks use to create money, and the interest on that debt is how they extract it from you. Every credit card balance carried at 22% is a direct transfer of your wealth into bank profits. Paying off high-interest debt is the highest guaranteed return available to any ordinary person. The vault was always a myth. The money was always digital. The spread was always running. And the risk was always there, hidden behind marble and confidence and the reassuring weight of a heavy door. Now you know exactly how the machine works.